This is Chapter 9, Long-Lived Tangible and Intangible Assets. Long-lived assets are assets that are actively used in the operations of a business that are expected to benefit the operations into the future. Now, there are two major categories of long-lived assets. The first one we're going to talk about, tangible assets, are assets that have actual physical substance, like land, building, equipment, and fixtures. And we tend to appreciate those items that have a limited life or things that we're only going to use for a certain period of time. Intangible assets are long-lived assets without physical substance, things like trademarks, copyrights, patents. Some of those have a limited life and some don't. We use amortization for those intangibles with limited life. So let's apply the cost principle to the acquisition of our long-lived assets. The cost of a tangible asset, as we've learned before using the cost principle, will be recorded at cost. But it not only includes the cost of the purchase price, it's also going to include all expenditures needed to prepare the asset for its intended use. Recording acquisition costs as assets is referred to capitalizing the cost. In other words, the asset we place on our books doesn't include just the purchase price. It will also include all the other fees associated with it. So as opposed to writing these expenditures off as a direct expense, we capitalize it, which means we turn those costs into an asset. After a tangible long-lived asset is purchased, a company may incur additional expenditures over the course of the asset's life to maintain or enhance its operation. And these expenditures are broadly classified as either ordinary repairs and maintenance or extraordinary repairs and maintenance. An ordinary repair is something that's frequent and small, usually something very routine, and it has no change to the productivity or the life of our asset. We put those straight into an expense account when they are incurred. However, extraordinary repairs, replacements, and additions that are probably large overhauls to our property, plant, and equipment that result in an extended life of our item at hand can be included into the cost of the asset on the balance sheet, and they aren't directly expensed. So we say that we go ahead and capitalize it. When purchasing land, the cost includes the purchase price, legal fees, survey fees, title search fees, all these other costs. All of that's going to be included in what we put on the asset on our balance sheet. Land doesn't lose its value over time. It doesn't have a limited life, so we don't actually depreciate land. Now, whether we purchase or construct a building, the cost should include the purchase price plus any legal fees, appraisal fees, contact fees, any other costs required to prepare the asset for its use. And then the cost of equipment will include the sales tax, delivery charges, installation costs, all of that stuff. All of those costs are going to be grouped into the cost of the actual asset we put on our balance sheet. So if we expense something, we write it off into our income statement immediately. It becomes an expense. If we capitalize it, we group it into the cost of an asset and it goes on our balance sheet. We want to expense those items that do not give us an economic benefit far into the future. If we purchase a fishing boat to enter the shrimp business, that boat will actually last us through several years, and it does give us an economic future benefit. So therefore, we'd want to make it an asset and capitalize it. Okay, but on the other hand, if our business pays someone to scoop the poop at our vet clinic, then that would not extend the life of any asset or give us any future economic benefit past this year. So we want to go ahead and expense it. Buying a new industrial air conditioner is a large purchase, and it will last us several years. So we capitalize it and put that cost as an asset. Paying a maid to clean the office, it doesn't give us any long-term economic benefit past this year, so we'd probably want to go ahead and expense it. It's common for land and building to be purchased together, just as you would buy your own home. Since we would depreciate the building and not the land, we need to split the cost of the two. Based on an appraisal, we find the percentage of the value of each one of those items. So here we have land appraised at $170,000 over the total appraisal of $500,000. We can find the percentage of value of our land and our building, and we can apply that percentage to our purchase price. Therefore, we can allocate it in proportion to their relative market values. That way, we follow the cost principle. As accountants, we need to maintain the cost of those assets in our books by reducing the value and expensing it each period. Now, depreciation is a process of cost allocation. We allocate the cost of the asset to expense over its useful life in some rational and systematic manner. We allocate a portion of the cost to expense on the income statement each accounting period and use the account accumulated depreciation to represent the depreciation taken on the asset since its purchase. And this is deducted from the asset's cost on the balance sheet. Let's look at the effects of $130 of depreciation on the accounting equation and the journal entry to record the following. If we have $130 of depreciation, we will make sure that $130 goes into accumulated depreciation, which is a contra asset account. It decreases our asset. And we'll make sure that the other side of the equation for depreciation expense is reduction to our stockholders' equity. In journal entry form, we see the debit as an expense and the credit is the accumulated depreciation. Okay, so this is just kind of a recap from our prior chapter. That depreciation expense for the current year will be on our income statement. And the accumulated depreciation, the sum of all the depreciation to date, will be on our balance sheet. Now you're probably wondering, how much do we depreciate on our plant, property, and equipment each year? Well, there's three popular methods of calculating depreciation expense. The easiest and most widely used method is called the straight line depreciation method. In special circumstances, we may wish to use the units of production method, and we're going to go into details on all of these in a second. We would elect this method if the life of the asset is generally measured in terms of units of production. For example, airplanes keep highly detailed records of engine operating hours. The unit of production may be the operating hours of an aircraft engine. Now, the third method is called the double declining method. Under this method, we take more depreciation expense in the early years of the asset's life. Let's use the following information and apply it to all three of those different methods. Assuming we purchased a new go-kart for $62,500 and the ride has an estimated useful life of 3 years or 100,000 miles depending on what method we use, and an estimated residual value of $2,500. Now, residual value is the same thing as salvage value. It's the amount of money that we get for our asset when we're done with it. Managers choose the straight line depreciation method when an asset is expected to be used up in equal amounts each period of the asset's estimated useful life. Depreciation expense for each year is determined by taking the asset's cost less its estimated residual value, so $62,500 minus $2,500, and multiplying this amount by the fraction of 1 over the asset's estimated useful life in years. So we are going to depreciate 1/3 of its depreciable cost each year. Managers might choose the units of production depreciation method if the amount of asset production varies significantly from period to period. Depreciation expense for a year is determined by taking the asset's cost less its estimated residual value. So again, we start the same way as straight line, $62,500 less $2,500, and then multiplying this amount by the fraction of actual production for the period divided by the estimated total production of the asset's useful life. So we use 30,000 miles in the first year, and we expect it to last 100,000. So to get $18,000 of expense this year. The double declining depreciation method is used to report more depreciation expense in the early years of an asset's life, when the asset is more efficient, and less in later years, as the asset becomes less efficient. Depreciation expense for a year is determined by taking the asset's cost less its accumulated depreciation to date and multiplying this amount by the fraction of 2 over the estimated useful life of the asset. So we're not working with the salvage value at this point. We're just going to take the purchase price less any accumulated depreciation to date. Okay, so for the first year, we're going to depreciate $41,667. In the second year, because we had accumulated depreciation now, we'll subtract that from the purchase price, Still multiply it by 2 over the useful life of 3 years. And the second year, we will report $13,889 of depreciation expense. Depreciation expense for double declining is limited to the amount that will reduce the book value to the estimated residual value. So at some point, we're going to use that formula over and over again, and we'll get down to the actual residual value, and we won't do any more depreciation. We'll stop there. Whenever we do dispose of a plant asset, the first thing we do is update depreciation to date of the disposal. After completing the update, we can record the disposal with a journal entry. If we were going to sell equipment costing $100,000 with accumulated depreciation of $60,000 and get cash for it for $50,000, then the first thing we want to do is make sure we write off the original cost of the asset from our books. So we'd write off $100,000. Then we'd reverse the amount of accumulated depreciation we had recorded. So it was sitting there as a contra asset. We'll do the opposite and debit it for the amount of accumulated depreciation to date. We'll record the cash increase of $50,000, and then we'll record a gain or loss on disposal depending on if we make money or lose money. In this case, the sale of the equipment was $100,000. We depreciated $60,000 of it, so we know that it's worth $40,000, but we made $50,000 cash. So our gain is $10,000. And here is our journal entry to show that transaction. Cash increased, accumulated depreciation was reversed, the equipment was written off of our accounts, and we recorded a gain on disposal of that asset. Okay, so one last thing we're going to talk about is intangible assets. Those lack physical substance, and sometimes it's difficult to determine the asset's useful life of these types of assets, or really any residual value at all. And we're going to review some of the major types and the related accounting procedures on these remaining screens. A trademark or trade name is any symbol, name, phrase, or jingle that is identified with a company or product. In this case, I showed McDonald's. It can be anything like Nike's check symbol, anything that is a symbol, design, or logo associated with the business. McDonald's internally developed its trademark. It's not going to have any recorded asset cost. However, if a company purchased a trademark, then they could actually record that trademark at cost. A copyright is an exclusive right granted by the federal government to protect artistic or intellectual properties. They usually have a life of 70 years after the creator passes away. We can amortize that cost over the period benefited. A patent gives the holder the exclusive right to manufacture and sell an item or process for actually 20 years. And a patent is amortized using the straight line method over its useful life, but never more than the 20 years. Licensing rights grant limited permission to use a product or service according to specific terms and conditions. Intangible assets also include technology assets like software and web development work. A holder of a franchise has the right to deliver a product or service under conditions granted by the franchisor. You probably can't drive down any major street without finding a number of fast food franchise operations like Wendy's or McDonald's. For example, a business can buy franchise rights that allow them to use maybe the Krispy Kreme's name, their formats, their recipes, all of that. Goodwill is kind of an interesting thing. It's actually not a thrift store. It's an intangible asset that's created when one company buys another company. If the purchase price of the company is greater than the fair value of the net assets purchased, then we call that goodwill. And goodwill is actually not amortized at all. Amortization for a patent that cost $800,000 and lasts 20 years using straight line would result in $40,000 amortization expense each year. So we just use straight line for those intangible assets. And lastly, the fixed asset turnover ratio is a good ratio we can use to look at our fixed assets and the use of those assets to generate revenue. Fixed asset turnover ratio is computed by the net sales revenue for a period of time, usually a year, over the average net fixed assets. See the average there again. That's the average between the beginning and the ending year for all net fixed assets.